Peter Churchouse is Advisory Director at Morgan Stanley Asia and joins us this morning. Morning, Peter.
Morning, Bernie.
What are you expecting from the MTR? Sixfold. I guess it's different reasons from last year.
Yeah, very much so. In actual fact, we think it could be a little higher than sixfold. It could be more like 9 times. But bear in mind, yes, I think you hit the nail on the head. Traffic volumes on the MTRC have risen about 12 or 13%. So you'll see a little bit of improvement in the core business, but largely it's real estate. This company is not a transport company. It's a real estate company. If you strip out the transport side of the business for full year profits, about 80% of it is property related, either from rentals or property sales or from that side of the business. The transport side is not really a very profitable business.
Yeah, you talk to people in the market and the argument has gone on for years whether they should be involved in both. We'll leave that to
another debate.
Another time. How well are they actually doing? Because it appears that they might take some of their developments, say Tongcheng and Kowloon Station, deferred profits and actually book them this time, which might actually skew the results a little bit.
Well, yes, they have this ability to defer development profits, and you never know quite what they're going to do. It's not a publicly stated policy, but they have that ability to smooth earnings out over time by deferring these profits. Quite honestly, what's probably more important for this company right now is its discussions of merger with the Kowloon Canton Railway. That's probably more significant, really, than the short-term earnings numbers that we're going to see.
What does that do to the MTRC's prospects? I mean, if the rail operations are a bit of a bugger, then merging with a bigger rail operator, what does that turn them into?
Well, basically, it turns them into a situation where the government still has to keep subsidizing this development, this industry, by giving them development rights. They've sort of a social compact, if you like, with shareholders that says, we're going to give you 8 or 9% internal rate of return on this business, but the railway gives you 2 or 3% internal rate of return. So we've got to top that up by more and more air rights development, property developments, which I think the rest of Hong Kong is getting a bit fed up with, because in effect, Kowloon Canton Railway and the MTRC are in effect becoming de facto land policy of Hong Kong.
I see you have an MTR report there from your house. My eyes are failing me. Does it say buy, sell, or hold, or does it say something else?
Underweight.
Underweight.
Underweight for Mass Transit Railway Corporation.
And that's on concerns about the rail operations.
Absolutely, and there are political pressures here leading to, I think ultimately, there may well be some sort of political pressure to take away some of this assumed development subsidy that this company gets over the long term.
Okay, another company reporting today, Jardine Matheson's Hong Kong Land. It's been listed in Singapore for, what, 10 years, something like that, so the Kazakhs aren't subject to the takeover code here in Hong Kong. Some things going on in the market. I believe Price Waterhouse is moving to IFC from one of the central buildings here. We've got part of the Landmark, the shopping center and office building, being redone into a boutique hotel as well. How is the property market looking? Vacancies in grade A props are under 10% now.
That's right. This is, I think, a real strong recovery story here, and I'd be absolutely gung-ho on this story right now. The office market, as you know, has suffered very badly in the last couple of years, but in the last 6 months, we've really seen this market turning around. As you say, office vacancies are coming down below 10%, and rents are probably up 30 or 40% in net effective terms over the last 5 or 6 months. Hong Kong Land will be the biggest beneficiary of that, is probably more geared into the office market than any other company in Hong Kong. And as well as that, the retail side of this economy is actually doing quite well also. And on top of that, they're doing some quite nice things on terms of property sales and residential. So this is the company I think as a stock one really wants to keep an eye on.
I pulled up the graph here. You can see we're at or near a one-year high on Hong Kong Land at $1.84 in the Singapore market. So your call is a buy on HKL at this level?
I would say Hong Kong Land is a stock that could probably go to 240, 250 over the course of the next 12 months as the office market picks up further. This is a stock I think that you really want to keep an eye on. It's a good, solid company. It's well run. It's well managed, and is just going to go from strength to strength in the next 12 months. And
the neat thing about it is, if you're a shareholder and you want to go to the annual general meeting, you get to go to Hamilton, Bermuda, right?
That's correct, and they're very good at that too.
That's some perks you just can't buy. Peter, thank you very much for your time. Peter Churchouse, Morgan Stanley.